Ladies and gentlemen, good morning. Let us review very quickly the price action of the last week, which was almost non-existent. It's as if we have already started the pre-Christmas period. This is the 2-year note, which moved, it's a daily chart of the 2-year note. It's moved very little last week and finished on the highs. It hasn't even attempted the very important 108.17 level, and it has now rallied back towards the 108.29.5 level, which is going to be very important on the upside. We think that until we see something quite decisive from the Fed, apart from the one rate hike and then nothing for another year, or at least until the market starts anticipating it, we are likely to stay in this trading range for quite some time. But the 2-year note isn't the one that's going to be important. The 5-year note is going to be much more important. As we keep on telling you, the belly of the curve from now on should absolutely set the pace for rate rises or expectations, or tell you what the expectations of the market are for rate rises. Here we have the daily chart with the levels that we have put in stone, which are 187% and 161%. The market tried to break it on the upside on Thursday, failed, came back in, and now will probably trade in this kind of area. We would be very surprised if the market went back to 161% at any time soon, simply because it would make it too easy for people to set up positions at a very good level. If the market does that, if the market gives you an entry at a favorable level too easily, well, chances are it's going to screw you completely and come all the way back down to here at the very least. So if the market now trades in an area, say between 187 and probably 173 in a very narrow range, and works off these overbought conditions, then we will be much more certain that it's going up rather than coming down. But in any case, there is absolutely no need to anticipate this break, because the move off it, and we can actually see on the weekly chart how significant that is. Here we are. We have been basically 3 years of trading which has been bounded by this top line, and we can see how the market failed, retraced. A weekly break and settlement above this 187 level is going to be so bullish for yields that there is really no point in anticipating this break. So just wait. Hopefully the market will come back slowly towards the 161 level, and those will be good levels to initiate long-term call spreads in the yields and put spreads in the price of the 5-year note, etc., etc. But we will decide about that when it gets there. There's absolutely no point in being short FV long yields at these levels. Everything is outside the daily and weekly Bollinger Bands. So let it come back, or let it prove itself and settle a whole week above that level. Being short FV or long yields here is bad risk reward. No point in doing it. No point in getting putting on positions at bad levels. The 10-year note, oops, cancel. The 10-year note actually is just as interesting. This is the weekly level. As you can see, it has retraced and bounced off this very important level. It has broken the downtrend line, and what would we not be surprised to see? We would not be surprised to see some bear flagging in terms of yields. This level is 249%. Let's call it 250. Extremely important. We think it's unlikely to be broken this year. We would like to see some bear flagging now down towards the 220 level. We just don't think it's going to succeed in breaking much below 220, and then at some stage next year a defining break of 250, and then we're off to the races towards the 3, and then finally towards the 350 yield level up here. It could be making even a very long-term inverse head and shoulders, which would eventually target 7-8%, but that is really much too early to decide, and there is no point in doing it. All we're saying is that being long yields at these levels is bad risk reward, because any settlement 2, 3, 4, 5 basis points above here gets you into a position which should break immediately, rather than just sitting in a position and sweating it for the next probably couple of months. The 30-year note is also indicating signs of exhaustion on the upside. These trend lines have held for best part of 30 years, and as you can see, the market tried to break higher, came back. It would not surprise us again to see bear flagging between this level of 3%, 306, and a level somewhere around here, around the 280. So that's a 25 basis point range for the foreseeable future, for the next 4 to 8 weeks, before it generates enough impetus to break higher. All these yields are very much overbought on the daily time frame, if not on the weekly time frame. You can see the 200-day moving average is all the way down to 251. We have really the levels that we would not be surprised to see in the slightest during this retrace is 275 yield, which is this kind of level here between 275 and 271, and that would actually fit very nicely with 2 or 3 weeks of the market having digesting the interest rate hike that we will no doubt get from the Fed within the next 10 days, and then sometimes in January building up a head of steam and going higher. But again, no point in having any positions here, just bad risk reward. The European Bund is actually telling us exactly the same as the charts of the 5-year, 10-year and 30-year bonds. We can't really show you a price chart of the Bund because of the contract rollover, and it becomes very messy, so a yield chart is much better. This is a weekly chart, and we have this downtrend line in the weeklies, which comes down just below the 40 basis points level, somewhere around the 35 basis points level at the moment. As you can see, this has been an area which has been very heavily traded and is significant for a variety of reasons. We would expect now the Bund to trade down in yield towards the 7 to 10 basis points area over the course of the next few weeks, as the ECB does its magic from Thursday onwards, and then having built up some sort of a bull flag over the course of the next few weeks, in the early part of next year break that downtrend line, which by then could be somewhere around the 25 basis points or so, and indicate an overdue move in the bunds, which we would not be surprised, take it all the way to 115. So that is going to be a massive move, which again there is no point in anticipating until it breaks on a closing basis this downtrend line. We are watching it like hawks, and we will naturally advise you if and when it happens. Well, since those are the expectations for the interest rates, the markets that are guided by them should now retrace their previous steep falls. This is the euro. We would not be surprised now by a squeeze on the back of the ECB action on Thursday, this Thursday, all the way up to around 1.9 to 1.11. It would not be surprising. And from then build a head of steam to move back down. But we shall see what happens. Certainly we are convinced that this is a chart of the dollar weekly. We are convinced that the market will be much lower within a period of years, but that doesn't mean that we want to fight the trend up. We will certainly have very good support somewhere along this trend line. If the market now comes back towards the 98 level, we would not be surprised that it's caught and then gives us a further leg up towards the ultimate objectives, which in this wave, which is wave 5 of the DX, are around the 105 to 107. We think this has been just too easy. People have been buying dollars hand over fist and making money. They will probably all get stopped out, and people will have an opportunity to buy the dollar somewhere around 98 for the final move up. That ties in with a period of several weeks where the bonds retrace their very steep falls, and therefore we would not be surprised to see that happen. That is also reflected in gold. On a weekly chart of gold, we would not be surprised to see the price now having held this 1175, 1180 area, to now be able, which is very crucial, be able to retrace around the 1230, 1240 level, stop everybody, all the shorts out, and then probably go again to in the early part of next year and challenge the lows around the 1050 area. But that is very much for a later stage. These moving averages on the weeklies need to turn. What is more elegant than a rally back up towards the 1230, 1240 area, stop all the shorts out, and then go again. So everything that we are seeing in gold and in the dollar suggests that interest rate differentials are going to remain steady or come in over the course of the rest of the year, which would be healthy for a big move into the early part of next year. The expected retracement in bond yields is actually so it shouldn't be fundamentally bearish for equities. There is no reason for that, but probably what it signals is some more reallocation of between sectors in the S&P 500 towards buying back the beaten up bond-like stocks, and therefore we expect a tightish range in the S&P 500 between 2150 2160 as these moving averages move up, and the 2230 level that we've been looking for quite a while to cap on the upside, which we shall see later in the Blue Angels. The bonds and the stocks especially, this is a weekly chart of the stocks, tell us there is huge support around the 2980 level from all these moving averages, and the stocks and the DAX are the ones that could surprise to the upside into year end. Don't forget that they are at exactly the same level as they started the year, i.e. they're not up a single percentage point. Therefore, they do have room to move higher. The We would not be surprised if after the Italian referendum and the actions of the ECB on Thursday, there is some kind of a relief rally towards the 11,250 level in the DAX. We're certainly far more positive of DAX and stocks than we are of the S&P 500. We just don't see that much room in the S&P 500, while we see a lot of room on the upside in Europe if some of the uncertainties that Europe is subjected to can be cleared up one way or another. So we are still, rightly or wrongly, more positive on European equities than we are for US equities. But that is just our preference from what we see and the level of cheapness of the market that we see. Running through the fundamentals, it's quite obvious that the market is in a firm uptrend. That's why we think it's unlikely to break down below this congestion area here, which is in the 2140s, 2150s, and it will be bounded by the 17-time blue angel, which is around the 2230, 2235 level. The sectors themselves show why this is likely to happen. Consumer discretionary is, doesn't have that much room on the upside to run. It is not an attractive sector, which with this kind of earnings expectations slope. The consumer staples are now probably going to be able to rebound a bit if bond-like stocks are bought back. Energy still a mess and will stay a mess for a long time, and best to be avoided. Financial stocks have been jammed right up to the 14 times blue angel and can probably be jammed up only another 2, 3, 4%, and that will be the end of their run. So they don't have much more driving capacity for the index. Healthcare stocks, yes, they can bounce. They can bounce probably a good 10% into year end, and probably one of the more attractive sectors on a valuation basis going forward into 2017, but certainly not one which has momentum at the moment. They will not retrace on a dime and go up. They will have to spend a protracted period of time in this area before they make the next move, which we think is more likely to be towards 1,000 than 600. So, but it's going to have to be a good 6 months worth of consolidation in this area. The industrials, though, are firmly jammed up against the 18 times blue angel, and they are vastly overbought. With a picture like this, it's extremely unlikely that the S&P can withstand a rally of more than 2 or 3% from the levels that we are. Therefore, we are quite confident that the 2230, 2240 level is going to be able to cap it with some ease. Tech is not particularly cheap, but not particularly expensive. Therefore, if a move down towards the 15 times blue angel were to occur, it would be a very attractive buy for the long term, simply because it's the one sector which has a positively sloping blue angel curve, and the one sector which is not jammed up against ridiculous valuations. So any dip in XLK is likely to be a very good investment for the long term. Materials, again, quite overbought. They don't have much lead capacity. Telecommunications are one of our favorites. We do like them because they're cheap and they do have some bond-like qualities which should be able to be rewarded into year end, but they're such a small component of the index, they're not going to drive it very far. And utilities, what can you say about utilities? Again, small component, they will not do very much until year end. Given that those are our expectations, we think the biases for next week should be to buy long-term volatility in the bonds on squeezes, not where we are now, but on substantial squeezes up towards the 163, 164 area, where the bond yields around 10 basis points. One has to be buying long-term puts in the bonds at those levels. Yes, we expect a trading range between, a percent and a half lower than we are, i.e. 2160 and 2235 on the upside. NQ, as we've been trading last week, we like to think that it will break to new lows towards 4630, which could be a very important trade into 2017. Don't forget to buy the dip at 4630. Russell 2000 is our steady as she goes long-term favorite for longs, simply because it's least affected by movements in the dollar, and it's most exposed to the fact that to the sectors which should be booming under Trump, and also it would benefit from the multiplier of jobs staying in the US Midwest states, as Trump so badly wishes. He keeps on tweeting about companies being punished if they move offshore. Well, if they don't move offshore, you have vast multiplier effects for smaller companies in the Midwest US, which become suppliers to or stay suppliers to those companies. So it's very, very important for the Russell 2000, and therefore the Russell 2000 should be very well underpinned on any dip down. TLT, as we said, we would hope there will be squeezes up to 127.50, and that is the level that one has to put on some positions at. We will naturally tweet when that happens. FV, the 5-year note, we have the 187 to 161 yield levels that we are watching like hawks. And the US dollar, we think you have to be long volatility. It could spike much more given the Bund 10-year note situation. Naturally, this is over the course of the next few months, or completely reverse the Trump rally and possibly go to 115, 120, depending on what the Trump policies actually happen to be once he is in office. Therefore, we think that over the course of the next 6 to 9 months, you're going to have huge volatility in the US dollar, ultimately resolving with the US dollar being substantially cheaper than it is now. But that doesn't mean it's going to happen in one foul swoop, or that it's going to happen in a short period of time. Long-term volatility is something that one has to be long of, and we're talking about 1-year volatility, maybe 2-year volatility. We certainly think that that would be a very interesting position to hold. Now, do keep positions light ahead of the ECB. That is the risk event this week, not the Italian referendum. The Italian referendum, a no, is 99% priced in, or if it's not 99%, then it's 85%. But it's largely priced in. Do not trade on a no vote. There is absolutely very little to be gained by trading a no vote. The yes vote also would be, the reaction in the market, we think, will be very limited, because it really doesn't mean anything. It just means that a constitutional amendment will be passed. The Renzi government could still fall over all the other measures that they are proposing. So we think that the Italian referendum is actually not going to be that volatile an outcome, almost whatever it is. But certainly don't sell or don't trade on a no vote. It's not going to be profitable, we think. Anyway, thank you very much indeed for watching and listening, and we will be tweeting away with you the whole of next week, watching these levels that we've outlined. Thank you very much indeed.